Hi, everyone. My name's Sean. I'm executive editor here at the Daily Upside, and we're coming to you live from Future Proof in beautiful Miami Beach. Today, we're lucky enough to be joined by Mark Gatto. He's the co-founder, CEO of CION Investments, and we're here to break down AI, fintech, and how it's all impacting the private market. So, thanks so much for sharing some time with us today.
Thanks for having me, and it's good to be back. We did this last year, except the roles were reversed. I was asking the questions, and you were giving the answers. So hopefully, I can do as good a job as you did last year.
Well, I'm happy to be in this seat, and you'll be in the hot one this time, Mark. Um, so let's dive in and we'll talk AI. It's obviously been a huge driver for growth over the decades now, but it's really been impacting the markets in recent weeks, moving markets, shaving some market cap off some of the big incumbents, shaking investor confidence. Um, and some of that is kind of spilling over into those private investments as well. What do you think all the kind of impetus is for with these trades? Are they rotating and away from some of the big players? Where's all this AI disruption risk?
Sure. Well, software in general has been a very prominent asset class. A lot of funds and investment professionals have been attracted to software because of some of their characteristics. Software companies have high cash flows. They're low capital asset intensive, where you're not pouring a lot of money into it. So it's been an area where a lot of money's flowed. And now we're seeing AI giving people pause and a scare, if you will, because the belief is that some of the technology that AI brings to the table could disrupt or displace the software company. So there's been concern, rightfully so. I think it's at this stage is a little overblown and there's an overreaction, but that's not unusual when there is a disruptive technology, right? There's always something that comes out that people have concern about, but it takes time to really understand what the true long-term impact's going to be. So I get it, right? I'm using AI myself and doing things that uh, I wasn't able to necessarily do before and do it very efficiently. So there is going to be that concern, but I look at AI as more of an opportunity, right? I think there's going to be an opportunity for companies to be more productive. Even for software companies, I think there's going to be a use case where they can leverage AI to improve their products. Now, will there be some losers in this equation? Of course, there always is, but it's about, from an investment perspective, it's about managing those risks, understanding your portfolio companies, and hopefully you did a really good job of underwriting these names when you invested in the businesses. And hopefully they're supported by good private equity firms and they're well capitalized to either withstand a storm, so to speak, or more importantly, adjust, right? And I think that's really the name of the game here is how are these firms going to react given where AI is today?
No, I think you're right about that. Every time I use ChatGPT, I'm finding different use cases for myself. I didn't know I could do that. I didn't know I could use this to do that. So I understand the investor kind of trepidation in some of those names, but why do you still feel some software companies could be compelling investment? You said there are going to be winners and losers.
Sure.
How do you know
You have to look at software is a pretty broad category. So you have to really look at what are these companies doing? What area of tech are they in? What area of software provision are they in? And it's companies that are providing B2B or some sort of data gathering, critical data gathering, companies that are sort of foundational to a company, companies that are working within proprietary areas, they're going to be less impacted than, say, companies that are creating content, right? Or just managing information, generally speaking. So you really have to dig a little bit deeper. I don't think you can throw the baby out with the bathwater here. You have to really see what are these companies doing? Are they displaceable, right? It's something we talk about in underwriting, right? Even before AI, we want to understand, like, can this company survive, right? Or can they be displaced? Are they a critical service to a corporation? And if you can get your arms around those things, I think you can feel fairly comfortable. If we look at the software companies in our portfolio, they are actually performing very well. The loan to value equation is very favorable, sort of mid 35-ish% loan to value, right? Firms that are well capitalized, that have big private equity sponsors, So if you look at it from that perspective, from an underwriting perspective, and as a credit investor, that's very important to us. There has to be a lot of deterioration for there to be significant trouble, right? So we can sort of get comfortable with that situation if we did a good job underwriting the businesses going in. So with respect to portfolio companies, it's about being proactive, it's about being defensive, and really understanding where the pressure points are. In terms of new business, right? This is probably a great area to be investing if you're well capitalized and you have cash to put to work. It could be a great time for opportunity. So we kind of look at defensively on one hand, but aggressively and offensively on the other.
Sure, and that makes total sense. And maybe so we went over some of the opportunities. Maybe we'll take a look at some of the risks that are out there. Obviously there are some risks, but how do you look at it from? And I know we went through some of them, but what advice can you give to managers to try and help mitigate some of those?
So obviously, if you're invested in a company that has some AI stress point, right, you're going to be concerned, right, and you got to really understand, as I said before, is what is the displacement risk for that company? What are the pressure points? What type of industries are they in? Do they have any proprietary angle? Are they embedded in a company's foundational operations, right? And if they are, I think you can feel fairly comfortable. But it's not just about that. Like, what companies are you going to support if there is some sort of slowdown, right? You're going to support companies that have great management teams, that can be innovative, that don't appear to be on a pathway to be completely displaced. So you got to be smart about that too. There's going to be opportunities to support companies. I liken it to COVID, right? When COVID happened, everybody thought the world was going to end and every company was going to go out of business. And that wasn't the case, right? Management teams, they hunkered down, they got smarter about their businesses, they got more efficient, they look at their costs better, and they innovated, right? They pivoted and innovated and changed their business plans, and they came out on the other side. And I think that's what you're going to see for a large part of this AI disruption. You're going to see companies pivot, you're going to see them innovate, you're going to see them leverage AI, and hopefully I'm right. I think we're going to see a positive outcome longer term.
Yeah, I mean that's what a lot of their projections are seeing. Increase in GDP 2, 3, 4, whatever the projections are, but in the long run, probably will add value to most sectors. Where is that going to be? Is the $1 million question that everyone seems to be trying to find. But in terms of some of that just disruption, I guess. But the private credit, it's making a lot of headlines recently for sometimes good, oftentimes it's some negative headlines out there that we see. But what about AI's impact on some of the other asset classes, private asset classes out there too? I mean, we see kind of what happened in private credit in recent, I guess, weeks or months. What else are you seeing?
Yeah, private credit's been in the headlines. I think it's overblown. Clearly, I'm biased, but if you really consider what we do in private credit and how thoughtful we are about underwriting and picking good companies, good management teams, being with a quality manager who can maintain diversification, put in the work that needs to be done, private credit's not going away. It's a bona fide asset class. It's an enormous asset class, and the good managers will have success. And this market will, again, present opportunities for those that are well capitalized and can access the marketplace thoughtfully. But what's also making headlines is infrastructure, and much more on a positive side. We're not seeing negative headlines there, thankfully. And we have an infrastructure fund, so I'm happy about that. But AI has played an impact in that business too, because it's created these additional categories of infrastructure. I think historically people think about infrastructure as bridges and toll roads, where it also includes data centers, right? And what we'll call infrastructure adjacencies, where you're leveraging technology to create an asset class within an asset class, right? And we think, like any investment strategy, being diversified is the best way to play it, right? And if you look at infrastructure in general, and we're talking about a new opportunity for data centers and other AI-oriented infrastructure opportunities, but if you look at infrastructure historically, people would talk about clean energy, right? Clean energy, new technology, solar, wind, and that's not the place you want to be right now, right? And I would argue maybe data centers is not where you want to be looking right now, right? That trade maybe happened a year ago as we're building up to this. So when we think about whether it's credit, whether it's infrastructure, anything we do at CION, we want to be diversified, right? We think that's very important, especially when you consider our investor base, individual investors that can't take sort of undue risk. You need to be diversified. And that's what you're seeing, why you're seeing our funds perform. We weren't solely focused on software companies. A lot of our competitors were all in on software, right? That's not a good way to approach this business, our business, when it comes to the private wealth channel. So we want to be diversified no matter we're doing credit or infrastructure, and we want to take advantage of the opportunities that AI is creating within those asset classes. And we think there's a plenty of new opportunities that will arise as a result.
Yeah, I heard Elon Musk is trying to put data centers in space where it's nice and cool up there, and they can.
No one ever thought that was an infrastructure play, but it's going to be. Yes.
So we'll get you out of here on this one, Mark. You talked a lot about the opportunities. What is required really to maximize what you're seeing in these AI opportunities out?
Right. So I think right now it's the type of market where the manager is more important than ever, right? Manager selection is critical. We've been through an environment where rising tides lifted all ships, right? And everybody kind of looked good and performed well. Now is where we as a platform and the partners that we've selected to manage the capital that we raise is crucially important. And we think we've selected two of the best in Ares and Grosvenor for our credit fund and our infrastructure fund, respectively. But this is where discipline counts, right? You need to be very disciplined. You need to be experienced. You need to know how to underwrite these opportunities. You can't overlook little details. And I think in the past, you can overlook a detail and it wouldn't make that big of an impact. So managers that have that discipline, managers that have liquidity, right? If you're in a position where you're paying more attention to your portfolio company because you're doing workouts, well, you're not going to be in a great position to take advantage of the new opportunities that are out there. So we think discipline, right? Experience, being through different market cycles, and ultimately having that liquidity and that dry powder to be aggressive, to be on the offense in this market will make the difference for investors.
Well, good luck in the future. It's been a pleasure, always a pleasure. Thanks so much. I learned a lot, Mark.
Very good. Good to see you.
Thanks, everyone.
Thank you.